Bollinger Bands help define stages of a trend and measure volatility. It centers around a moving average referred to as the median, which is usually set to a 20-period moving average by default. The upper boundary is 2 standard deviations higher, while the lower boundary of Bollinger Bands is 2 standard deviations below the median. That means, statistically speaking, the vast majority of market movement will likely take place within the area defined by the Bollinger Bands. The following lesson examines this indicator with several real chart examples from various time ranges to see how this indicator can be used, in order to better understand its advantages and limitations, along with strategies and preferred and unfavorable conditions for its application. So information presented here can still be of use regardless of when you watch this or which particular charts you choose to apply Bollinger Bands on. In theory, the more price deviates below the mean, there is a higher chance of reversion back to the mean. But price won't always move back up towards the moving average, even though it may contact or even go below the lower boundary of the Bollinger Bands. In reality, it's quite common to see price sustain at or below 2 standard deviations below the mean, especially during a well-established downtrend. This idea is more applicable when the market is less directional, such as in this case when price is falling on a shallow slope much closer to a flat horizontal range. Under these more suitable conditions, stronger reversions back up towards the moving average can be more likely the further price falls at or below the lower boundary of the Bollinger Bands, such as the full candle below the Bollinger Bands at the beginning of November. The bullish reversion is confirmed once price strongly closes back up over the lower boundary and back within the range of the Bollinger Bands. Bullish reversion of the lower boundary is also more reliable when it takes place at a clear and major long-term support range. When there's a stable as opposed to a steep uptrend, retracement can regularly take place when nearing the upper band. As we saw before in the last example, when the bands contract into a horizontal range, contact with the upper band can have downswings commonly appear. These downswings are usually relatively small, but an initially gradual decline can sharply accelerate once price breaks below the lower boundary of the horizontal range. However, after a downtrend has significantly slowed down, and there's more neutral to bullish movement, downswings are much less likely, even though price can constantly trade within the upper half of the bands between the median and the upper band. So in this case, once the uptrend begins to accelerate, constant contact with the upper band can actually be a sign of bullish strength. Just like when there's a downtrend acceleration, a common sign of bearish strength is consistent contact with the lower band. Just like the beginning of this example, once the uptrend begins to slow down, the bands contract into a defined horizontal range. Downswings can occur more regularly upon contact with the upper band. Similar to how upswings are more likely when approaching the lower band during these contractions of the bands into more clearly defined horizontal ranges. But even these more suitable conditions don't guarantee swing points will always take place at the upper and the lower boundaries of the Bollinger Bands. In the bigger picture, the chart does remain relatively horizontal, but that temporary spike in bullish volatility defied bearish expectations for a short time. In the short term, the same thing is happening right now, with a volatile bullish continuation sharply increasing price in a short time, while remaining at or above the upper band. It's not a big surprise, since rows of green candles and higher buying volume can temporarily keep price around the upper band and delay the natural tendency for a bearish reversion back to the mean. In contrast, bearish reversion back to the mean is more consistent and quick when the bands contract and move towards more horizontal ranges following steeper trends. Just like the last example, we see common characteristics of higher volatility during steeper portions of a trend that eventually have a noticeable contraction. In this case, since there is a contraction and price goes mostly neutral to slightly bearish, a continuation to the ongoing uptrend becomes more likely once the bands begin to expand. Essentially, these are the classic characteristics for continuation potential. They're repeating again here. Since we're in the context of an ongoing uptrend, we'll be looking for a spike of bullish volatility, which will take the form of price rising towards the upper band, which is also the upper boundary of this relatively horizontal narrow price range. What we look for with the Bollinger Bands is consistent contact with the upper band, while the area of the Bollinger Bands expands to indicate higher bullish volatility, which is often the result of increased buying volume that produces rows of larger green candles. But of course, this can't be sustained indefinitely. So bullish volatility eventually decreases, and that takes the form of the Bollinger Bands contracting into flatter ranges. Let's take a look at this from a bearish perspective, where it's essentially the same thing in reverse. After a steep portion of the downtrend, there's an obvious contraction of the Bollinger Bands. Thus, a bearish continuation will look for a return to increased bearish volatility that sees the Bollinger Bands rapidly expand as price maintains firm contact around the lower band. Bullish retracements like this are natural, but we don't want them to close back over the lower boundary of the previous horizontal range that took place just before the volatility expansion occurred. The wider expanse of the Bollinger Band is maintained as bearish volatility is maintained. Volatility in this case mostly refers to the steeper and faster portion of the drop that initiates the continuation. Recently, the downtrend is still being maintained. It's a steady drop with consistent contact at the lower band, and that means price is more stable and less volatile, which results in the bands not being as wide as before. That's part of the constant shift on the chart between lower and higher volatility, wider and narrower Bollinger Bands. The contrast between steep trends and flatter price ranges. When looking for the development of decisive reversals, we look to those familiar characteristics of expanding Bollinger Bands and price maintaining contact with the extremes of either the upper or lower band. Just like continuation ranges, reversal ranges are also likely to form during the course of Bollinger Bands contracting into a more narrow horizontal range. In this example, when we're looking for a bearish reversal of this uptrend, instead of a break higher with bullish volatility for a continuation, we want to see that Bollinger Band expansion occur when price remains consistently around the lower band for a conclusive break of this range, which defines the bearish reversal range with its relatively narrower and flatter structure with both price and the Bollinger Bands, which is in contrast to when the reversal begins to decisively break lower, where during some of the steeper and more stable portions of the drop, price is consistently around the lower band and the Bollinger Bands are generally expanding. During this well-defined trend, there are good examples of clear and often sharp reversals at areas of confluence, where price reaches the boundaries of the Bollinger Bands to form distinct candle patterns with quick confirmation. Recently, there's been a clear shift towards moving into a horizontal range, which allows us to build on these basic observations. Again, clear reversal candle formations with quick confirmation at the boundaries of the Bollinger Band, which can also be considered near the top of the boundary for our horizontal range and this more recent double top range, which, as would be expected, produces a consistent and sharp drop. Naturally, such a steep downtrend is able to maintain contact very close to the lower boundary of the Bollinger Band for quite some time. As price falls towards the $2 boundary, the first default Fibonacci extension level close to 250 helps better define a more realistic lower boundary, rather than just one single price level. Because as we've seen before in previous examples of sharp trend accelerations, the strongest portion of a trend will move close to the boundary of the Bollinger Band. But when the trend slows down for the possibility of a reversal or continuation, price will often drift away from the boundaries of the Bollinger Band. So these additional references in the mid to low $2 range help define the area where neutral to bullish movement was more likely to form, following the double top acceleration beginning to slow. For more on indicators, including other variations of Bollinger Bands, as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.